Yo, what's up you guys? Welcome back to another video. Today we're gonna discuss risk management. Now, to kick off, the question is, what is risk management? Now, risk management is exactly what it say it is, right? It is risk management. It's managing your risk. It's managing how much you're going to put into the market, how much you are capable or comfortable with losing in the market. Today, I'll show you how to calculate your risk, and we're going to talk about risk management. And that's very important that you keep in mind that this is one of the most crucial things that you need to learn when it comes to trading, because it's the most fundamental key element that you require to make sure that you stay in the market long term, right? Now, a lot of signal providers out there like the FX Goats, Kojo, Forex, Rahul Lamborghinis, these guys, they use the 1, 2, 3, like Lambo Rahul uses 5 or 6 take profits, and these other guys, they use 2 to 3 take profits, right? Sometimes it becomes very difficult for you to calculate your risk, because in order to calculate your risk, you need a stop loss and a take profit, just one stop loss and one take profit. Now, if you have multiple take profit, it becomes more difficult. But let's jump straight into it. So the risk management is obviously the key in order to make sure, like I said, that you stay in the market. Now, as a general rule of thumb, what you need to always risk is always be risking 1% of your account. 1% of your balance. Now, even if you are dropping with your balance, you need to maintain the 1% rule. Now, if you're using a funded account, you can obviously reduce that risk to 0.5%, because if you do that on a 0.5% risk on a 100K account, you'll be risking about $500 in order to make $1,500. Now, that's if you're using a 1 to 3 risk to reward. And obviously the reward, I would say you can aim for 3%. You can go with 2% or anything like that. But I'll show you how we're going to get there very quickly. Now, we're going to use the example of, let's say you have $100,000 balance. Now, remember, this applies for $10,000, $1,000, 500 Rand, 200 Rand, it really doesn't matter. But one thing that you must understand is that the less money you have, the less exposure. Sometimes you aren't even capable of trading. The risk management calculator will tell you there is no lot size for that. And I'm speaking to you guys who likes to trade Nasdaq and the Dow Jones, you know, with small accounts, thinking your life is going to change. But in any case, you always want to go with a 1% risk and a 3% reward. Your risk is like a budget. If you have a job, you should know that when you get paid, you obviously work out how much money is going there and how much you're going to use for yourself, right? The more you understand where your money goes, the more you control your money, the less the money will control you. The less you will have emotional damage when you get to a loss. Now, let's go back. We're going to use two scenarios, right? We're going to say we have the first one here. This is someone who is going to risk 3%, right? Also with a 3% reward. Now, these are the two types of traders that you'll find in the market. Now, the person who's risking 3% might have not calculated their risk, and that's probably most of you, who just use a random lot size. Now, I've seen someone in a signal group that will be reviewed sometime next week. You'll see they say that you need to risk a minimum of 2%, but the reward is not even 1%. So how will you ever recoup the money that you might have lost throughout the stop loss? Now, let's assume this is the case, right? Let's assume you want to go and buy Euro USD. Now, you might have identified, right? You've done your technical analysis and you say, I want to get in there. Now, these tools in TradingView is called a long position and a short position. The short position is for selling and the long position tool is for buying. Now, this basically gives you the risk to reward. Now, how does this work? At the moment, you'll see there's a 1. Now let's assume that we do want to buy it, we do want to sell it to this level here, right? Now let's assume we only want to risk 1%, but we would like to adjust this to 3%, right? Let's say we want to calculate what lot size we need to use to make 3%. What you do is you would scroll this all the way down until this is a 3, right? So there we go. So once it turns over to a 3, that now means that now the trade is a 1 to 3 risk to reward. But let's assume that you do want to protect your stop loss by structure. That means you're going to move that slightly higher. Now what this tells you basically is what you see there's a 1.68. So you basically risking 1% of your account to make back 1.68%, which is basically just over 1.5%. Why is this important? It is important so that you know that when your stop loss hit, you're not gonna faint and feel panic attacks or anything like that. You already know what your stop loss is gonna be. Now, how do you know what lot size you need to use for this trade? You're gonna go and say, you are going to, once you have basically set out where your stop loss is going to be and your take profit is going to be and your entry, you're going to double click on this tool. Now you're going to copy the entry price. Next thing you're going to do is come over to this website called babypips.com, tool position calculator. The first thing you're going to do is put in your balance. Now remember I said that we are going to work off $100,000 balance, right? This is a funded account. Now, here's the important part. They are asking how much of your balance do you want to risk? Now, the first person, as we said before, we are going to risk 1% for this guy. And the reward over here, I'm going to make it 3% just for the purpose of this. So we're going to go there. There we go, 3%, right? Now we're risking 1% to make 3%. Now, once we come here, we say the risk percent, we say we want to risk 1% of $100,000, right? Now they're asking how many pips is the stop loss. Now all you can do basically is if you keep your mouse over here, you can see there it says 41.6. Now that is the amount of pips the stop loss is. So we're gonna round it off and we're gonna say 42 pips. Now the currency is going to be Euro USD there. Sorry, why did I say a 42? I don't know why. There we go, 42 pips, right? Easy stuff. Now you're gonna say calculate. Now this is where it becomes very interesting. Now this is where you see, okay, I am going to risk $1,000 on this trade, right? $1,000. If my stop loss hits, I will be making $1,000 on. I'll be losing $1,000. So here SL equals minus $1,000, right? Now we are going to look at the lot size. The lot size we're going to use is 2.38. So now you can comfortably go onto MT4 and you can now sell Euro USD and use this as your stop loss and that as your take profit. So you know that when the stop loss hit, you should lose $1,000, and because your take profit is at 3%, when your take profit hits, that means you should be able to bank $3,000 on that trade. Why? Because you are risking the 1% at the top to make 3% at the bottom. So this 3% will give you $3,000, and when your stop loss hits, you know you'll be down $1,000. Now you know what the beauty of this is as well, is that if you even go as far as risking 0.5%, now that means when your stop loss hit, you would be down $500, and when your take profit hit, you would have made $1,500 as well. Now if you ask someone like me, is $1,500 a lot? Yes, it is a lot of money. So I would be happy to make $1,500 on a single trade. So that would be a good reward. Now we're gonna use the same example over here onto someone that doesn't calculate their risk, or that just goes into lot sizes randomly. This guy, he's also using, he's gonna go, we are gonna go do that. Let me just go back there. Let me just do that and then just go 1 to 1. Right, so this guy is basically going to risk, right? He's risking 3% in order to make 3%. Now, if you go to the risk calculator, the only thing we need to change over here, sorry about that, I'm gonna keep this also as is, just for as an example. Now we're gonna say 42 pips, and we're gonna say we would like to risk 3% in order to make 3%, right? So now what this means is that if we click calculate, now we know that we stand a chance to lose $3,000 if the stop loss hits over here. Stop loss equals minus $3,000, and if the TP hits, we will then make $9,000. Now, you see, now this is where the saying comes. You have to risk enough so that you can stay in the game longer. Now, we can take this and we can go as far as reducing this risk. You see, now let's assume that your overall loss on the account shouldn't exceed, let's say, $5,000. Let's call it $6,000. On this account, if you hit 2 stop losses, okay, then the account is gone, right? So you only get basically 2 chances, right? You only get 2 chances to be right on this account. But if you are right, you will be rewarded, right? Then you'll get a good reward. But you only get 2 chances. If you're wrong twice, my friend, then the prop firm is gonna come and they're gonna stop your account. Now, if you're only risking 1%, you will have 6 chances over here before account lost, right? So here now you will make less money, which is sorry about that. So we have to pull this back very quickly. 1,000 and TP will be 3,000, we said, right? So here you will have 6 chances to get to take a trade. You can be wrong 5 times and maybe be right once, but you have 6 opportunities in the market. Now we can take this a notch even further, right? Like I did before. Now let's say you want to go even further down, because remember, the bigger the account size, the less your risk can be. So now we are down $500 and we're gonna make $1,500. But now we have 12 chances to basically trade. You see what happens when you reduce your risk. The less your risk, the more opportunities you have in the market. But ek kry dit nou vir uitgevriet, right? A person who deposits 1,000 and they go in there, I'm going to stack. Only one opportunity, and then the account blows. And they're like, my friend, why did you not tell me? No. Always calculate your risk. Jou ma moet vir jou die geleer het. When you get paid, you work out your budget. As soon as you deposit your money and you see a signal coming through, hopefully not Andy FX Coach or any of the people that I'm I'm busy looking at, you first come here and you calculate your risk. Once your risk is calculated, go place your trade and do whatever you want to. Now, also, if you get TP1, TP2, TP3, TP4, TP5, that is on you. Don't even go to people who send signals TP1, TP2, because you will hit TP1, TP2 that might be at a 0.03%, then a TP. Now it looks good, right? Because there's multiple TPs that are hitting. One stop loss, boom, and then it wipes out all of those trades. But you don't see that. Any case, that is it from my side. There's the website. There's risk management. That is how you calculate it. That is the tool that you can use to do it. Thank you for your time. And as always, cheers for ears.